Hi, I'm Tom Dalton. This video is about the effect of liabilities when forming a partnership. It is the third in a series of partnership formation videos. Let's get started. Before we look at any numbers, let's look at the basic idea. The most important aspect of partnership formation is keeping track of the partner's tax basis in the partnership interest. Basis in the partnership interest determines whether or not the partner gets taxed on formation, on taking distributions, and also whether the partner can deduct his share of partnership losses. When a partner contributes cash or property to a partnership, the tax basis gets larger. Simultaneously, the partner's capital account gets larger. When a partner takes a distribution of cash or property from a partnership, tax basis gets smaller. Simultaneously, the partner's capital account gets smaller. Transfers of liabilities work in much the same way. When a partner contributes liabilities to a partnership, the transfer is treated as a cash distribution to the partner. Consequently, tax basis will get smaller. When a partnership transfers liabilities to a partner, the transfer is treated as a cash contribution to the partnership. Consequently, tax basis will get larger. When a partner is allocated a share of partnership profits, that makes the partner's tax basis get larger along with the partner's capital account. When a partner is allocated a share of partnership losses, that makes the partner's tax basis get smaller along with the partner's capital account. All of these events make partnership basis get larger and smaller along with the partner's capital account. But there is one more step in calculating the final basis in a partnership interest. We need to calculate the partner's percentage share of the partnership liabilities. These are liabilities that exist on the partnership balance sheet at the end of the year. If, for example, a partner is somehow allocated 50% of the partnership liabilities, then we will add this number to everything else we calculated that affects the partner's capital account to arrive at the partner's total basis in his or her partnership interest. Note, however, the partner's share of partnership liabilities does not increase the partner's capital account. It just gets added to the calculation. Of course, it's important how we calculate a partner's share of partnership liabilities. This can get a little complicated, and it depends on whether the liability is a recourse liability or a non-recourse liability. So we'll leave that question for a separate video. But let's take a look at the difference between a recourse liability and a non-recourse liability. Suppose a person borrows money from a bank and the loan is a recourse liability. And also suppose that the person uses the loan to purchase some land. That's great. But later, the person cannot make the payments on the land and it is repossessed by the bank. The bank sells the land to help pay off the debt. If the sales proceeds of the land are not enough to pay off the debt, and some of the liability still remains, then the bank can go after the borrower individually for additional money to pay off the debt. In a non-recourse loan, the land will probably be sold to pay the debt also, but if the sales proceeds are not enough to pay off the loan, the bank cannot go after the borrower individually to collect the rest of the debt, and the borrower can just walk away. Now let's use some numbers to illustrate all of this. Let's say two people want to form a partnership. Partner 1 contributes $700 cash for a $700 interest in the partnership. Partner 2 contributes land worth $1,000, but the land has a recourse mortgage of $300 that will also be contributed to the partnership. So the net value contributed by Partner 2 to the partnership is also $700 the same as partner 1. Let's focus on partner 2. In the transaction, partner 2 receives $1,000 of stuff. He receives a partnership interest worth $700. Plus, he receives $300 relief of liabilities. In this step, the partnership has taken over the $300 mortgage. If the land had a tax basis of $400, then partner 2 has a realized gain on the transaction of $600. The $600 realized gain will not be taxable, in other words, recognized, because of Internal Revenue Code Section 721, which excludes gain when property is exchanged for a partnership interest. But Internal Revenue Code Section 731 also comes into play. Section 731 requires that a partner recognize taxable gain if the partner's tax basis in the partnership interest goes below zero. So, to be sure, partner 2 must calculate his tax basis immediately after the exchange. If his tax basis goes negative, then he will have taxable income, since, in effect, he took a distribution from the partnership in excess of his basis in the partnership interest. As you can see here, partner 2's tax basis starts with the $400 land basis. Next, we subtract the $300 liability that he contributed to the partnership. That contribution is the same as a cash distribution to partner 2. Next, we will increase his tax basis by the amount of partnership liabilities that will be allocated to him. Assuming he is allocated 50% of the partnership liabilities, and the partnership now has a $300 liability, partner 2 is allocated $150 of the partnership liabilities. This is considered the same as a $150 cash contribution to the partnership from partner 2. His beginning tax basis in the partnership is now $250. This is positive, so partner 2 has no taxable income on the transaction. But let's change the facts and make the liability on the land $900 rather than $300. Now partner 2 is only contributing value of $100 for a $100 valued partnership interest. To match partner 2, partner 1 only contributes $100 of cash. Partner 2 still ends up with a $600 realized gain, but his tax basis is different than it was in the first example. We start with the $400 basis from the land. From that, we subtract the $900 liability that he transferred to the partnership. Assuming that we allocate 50% of partnership liabilities to partner 2, we will allocate $450 of liabilities to his basis calculation. This would give partner 2 a negative $50 basis, but a negative basis is not allowed. To correct this, partner 2 recognizes $50 of taxable income on the transaction. This increases his tax basis by $50, bringing it to zero. If you're a journal entry kind of person, we can show this in journal entries. Here is the tax basis journal entry for the last transaction. Partner 1 contributes cash and gets a $100 tax basis capital account. Partner 2 contributes the land and the liability for a negative or debit $500 tax basis capital account. Allocating partner 1 half of the liabilities is not something that is done with a journal entry. It is simply part of the calculation for tax basis. So partner 1 ends up with a $550 tax basis in the partnership interest. Partner 2 ends up with a zero tax basis in the partnership interest. Here is something to think about, though. For partner 1, you can take the tax basis capital account plus 1/2 of the liabilities, and it will equal partner 1's tax basis in the partnership interest. If you do that for partner 2, however, you will end up with a negative $50, which is not equal to his tax basis of zero. Most of the time, you can calculate a partner's tax basis in their partnership interest by adding their tax basis capital account to their share of partnership liabilities, but not always, as you can see from partner 2's situation. The tax basis balance sheet is used to calculate gain or loss on the sale of assets and the partner's tax basis in the partnership interest. The fair market value balance sheet is used in calculating the share of partnership property that a partner would receive if the partnership dissolved. This is the third video in a series of videos about partnership formation. If you have any questions or comments, feel free to send me an email. If you like this video and would like to see more, feel free to hit the subscribe button.